Welcome back to the program. This is Capital Market live on Channels Television. Get on Twitter to tweet at Channels TV or at CTV Tempili just in case you want to join the conversation. But let's check out what happened on the major African market, our sister markets now. Kenya Airways PLC on the Nairobi Stock Exchange on Thursday resumed trading after a 2-week suspension. This is to facilitate the share split and simultaneous consolidation of the company's shares, which forms part of the Kenya Airways PLC capital transaction. Existing ordinary shareholders have seen their shareholding reduced through a reversed 1 share for every 4 held. Kenya Airways share price shot up by more than 130% to close at 12.50 shillings from its last closing price of 5.30 Kenyan shillings before the suspension. Victor Ofile is the research analyst at Kauri Assets Management Limited, and together we have been looking at the activities that panned out in the Nigerian capital market, both on the debt and equity side of things. But let's now bear our minds on the month of November, which has just ended, and we see that the data from the NBS, which is also corroborated by the Nigerian Stock Exchange as it concerns its monthly trading statistics, shows that we had over 666% investments in terms of foreign portfolio investments now in the market. Juxtapose how that happened between the foreign portfolio investors and domestic investors for us.
Okay. In the month of the figure you're talking about has to do with the third quarter of this year.
Yeah.
Okay, where basically we saw a boost in foreign portfolio investments. 66% of that went into equities. All right. So that also stems from the fact that the market saw that the economy had just left a recession. Okay, at around as at June, we had gotten this first quarter GDP result. We saw a decline of negative 0.55%. Okay, and so subsequently we saw that the PMI, which is the leading economic indicator, expanded for 2 successive months. 51 points in April and 52 points in May. Okay, and subsequently the PMI has increased. That's the manufacturing PMI has increased for 8 successive months.
Right.
Okay, to about 55.9%. So these are basically indicators that will suggest that the economy is really expanding. All right, before the GDP result or the fourth quarter came out, which we saw a 1.40% growth. Okay, in the economy. So all these things tended to boost the confidence in the equities market. Already, at that time in June, we already foresaw the market was going to close even higher than 40% year to date. Why did we see that? At that time, the valuations were quite cheap. Okay, Nigeria had a Nigerian market had a price to earnings of 15 times compared to advanced economies, where we saw like the UK market, specifically FTSE 100, we saw a PE of excess of 30 times. In S&P of US, we saw an increase, a PE of about 22 times. Right. So relative to other markets, and even talking about the BRICS economy and the MINT economies, we saw that our valuation was relatively cheaper than that. So all these kind of things tended to spark interest in our market, and that's what informed the influx of foreign funds to that magnitude into our market.
So when we have this sort of investments like this coming in when the year is actually coming to an end, what does it tell us about the earnings that will be coming in from listed companies?
I think, like I said again, referring to the PMI for November, okay, we saw an increase of about 55.9% points, expansion. So that means we should be anticipating a positive let me say, a higher growth in GDP by fourth quarter of 2017. Already year to date, we've seen the GDP increase by 0.45% year to date. That's computing each successive quarter based relative to last year. Okay, so it's pretty much moving in line with IMF's projection that our economy is going to grow by about 1.2%. Okay, this year. So we tend to see increased buoyancy in the market, increased boom in the market. Okay, even extending to next year, we should see much better performance next year as well in the equities market.
Okay, so, well, it all means that for foreign portfolio investors going to the equities side of the markets, 860.65% year-on-year growth is what we've seen this time. So for the fact that we've been seeing the improvements in macroeconomic variables right now, doesn't mean that attention will be shifting away from the debt markets?
Pretty much so. And I'll give you...
As part of the fundamentals of economics, right?
Okay, pretty much so. Let's talk about the debt, for instance. The current yield is about, for treasury bills, that's 3-4-day treasury bills. Current yield is about, let's say, 15.57%. That's what you earn per annum. But just this past week, we saw a Fidelity that gained 21%, just in a week. So you can't compare the difference in yields in equities and then in the difference in returns, rather, from the equity side and from the fixed income side.
In the debt market.
So we continue to see this kind of, let me say, lopsided returns. Is what is going to invariably lead to movement or rebalancing of portfolios in favor of equities.
So with what we are saying right now, it means a lot of companies will be able to post very impressive results for the fourth quarter of the year and, of course, the final reports for the calendar year 2017. Thank you very much, Victor Ofili, who is the research analyst at Cowrie Assets, for making it down to the program this evening. Thanks a great deal for your attention. In the week ahead, we have the NASD OTC CEO's Forum, which will be holding on Tuesday, December the 5th at Lagos here, basically. And, of course, the suspended Director General of the Securities and Exchange Commission will be facing the ICPC panel on Monday, December the 4th. These are some of the major events that you have to keep your eyes fixed on in the Nigerian capital markets, just in case you are an investor or a major shareholder in one of these companies. That's all the time we have this evening on Capital Markets. Thank you so much for being a part of it. I'm Temple Ashaju, and I'll see you next time.